Thank you for introducing the panel. Maybe I'll just start a few more things. So Claire, thank you for joining. As you heard, she's the former Minister for Energy and Climate Change, spearheaded the COP26 bid for UK, but also the Powering Past Coal Alliance. So very interested to hear about some of those experiences here. Ahmed, who leads East Asia, Southeast Asia, and Pacific for ADB. Very interesting to hear about the energy transition mechanism, which is very relevant to the topic that we're talking about. David GFANZ for APAC has been leading a lot of work on the coal phase out, but also the capability building for financial institutions more broadly, which could be quite relevant as we scale up. And John, thank you for joining from New York. I know you're driving a lot of interesting things in emerging economies, including the very recent $900 million investments in Chile around the similar topics. So it would be lovely to hear about your experiences from there. So if it's all right, I'll just try to set up this topic on the high-emitting assets. So a few thoughts to set it up, and then I'll open up for questions. Number one is the high-emitting assets, very relevant for this part of the world. And as you heard from Mark Carney in the fireside chat and some of the other panelists as well, one of the biggest risks we see is a lot of stranded assets potential as we move through this transition, right? And the most spoken about is the coal-fired power plants. There are about 5,500 coal-fired power plants in Asia with an average age of 11 to 13 years. And as we go through this transition, it's very important to think about how will this move. The second consideration as we talk about this is the quote-unquote the managed part. It's very important. We have seen in the recent past many established organizations trying to spin off very quickly to get away from the limelight. That doesn't help because then this is just a transferred emissions going into organizations that are not as scrutinized, right? So how do we address this second part around the whole managed? And the third part is about social justice and just transition. Given a lot of livelihood and economic development, especially in the emerging economies, to rely on these assets, right? By some estimates, about 4.5% of GDP of Indonesia, 2.1 for Vietnam, is linked to coal-fired and coal economy, as an example. So given these considerations, let me just throw a question into the ring and we'll to get the ball rolling, and I'll ask some other specific questions. What are the biggest challenges that you see in your respective roles for a managed phase out of high-emitting assets? I see, John, you very quickly grabbed your mic, so.
Sure. So look, I would say kind of key challenges from my perspective are threefold. One is the magnitude of the phase out needed. There are 2,000 gigawatts of coal-fired power plants still in operation around the world, 200 gigawatts still in construction as of today. 70% of that sits in Asia. We've talked a lot about the age of those assets, et cetera. To be even more depressing, over the last 20 years, there's only been 400 megawatts of coal-fired power plants that have been retired. At that pace, it would take over 100 years at this pace to actually fully decommission coal. And unfortunately, we don't have that time. According to the International Energy Agency, to meet the 1.5 degree pathway, the advanced economies would need to fully wind down coal by 2030 and the rest of the world by 2040. Secondly, the economics for phase out of coal-fired power plants is least compelling for emerging markets. The net book value of these assets is highest in these countries, given how young the fleet is. Most of these assets are insulated from market forces because they are owned by state-owned companies. They benefit from long-term PPAs. They're regulated entities. And finally, the demand for growth is highest in these economies, and the capital access is most challenging. And then finally, obviously, something that we think a lot about at Goldman Sachs is that there are significant financial market constraints for institutional investors and banks to invest in managed phase out. Investing in managed phase out of coal-fired plants is actually still investing in coal-fired power plants. And so with all of our net zero commitments and scope 3 commitments, it's actually very hard for us to invest in this. And then finally, there's really no standardized framework for banks to invest in kind of phasing out of coal power plants, and so important for that to be established for credibility.
They're great points. I wanted to build on that, and part of this was the logic for starting the Powering Past Coal, is that in order to solve the problem, you need a telescope to look around the world and work out the challenges, but also a microscope, because the sort of constant refusal to engage in the reality, actually, of a country's particular transition, particularly in the developing world, is very strong. I mean, I think my biggest challenge all along has been a refusal to engage in the world as we find it. And of course, we know that now renewable energy generation solutions are in the money and don't need a huge amount of subsidy in many parts of the world. But that is a tiny fraction of the phase-out problem, the issues of grid, of distribution, of storage, of actually the fact that many of these institutions are huge local employers and provide social and welfare benefits to their employees and communities. And that was the logic for starting Powering Past Coal, was that we needed to have a global landing zone from a telescope perspective where we could all agree that unabated coal phase-out by 2030 was a great shared aim. And we launched it at COP 23 in 2017. Incidentally, I was wearing the same jacket, I realized. How slow fashion right here. And we had countries and states and corporates falling over themselves to join, because finally we had a landing zone, and we weren't trying to have a specific pathway related to this challenge. Is the fact that we've demonized gas. And the way that we've decarbonized our energy system in the UK, where we've gone from about 40% coal generation of electricity in 2010 to less than 1% today, is that we went for a coal to gas plus renewables plus biomass switch. And for much of the developing world, gas continues to be a very attractive transition fuel. And yet, if you speak to very many of the NGOs and the campaigners, we cannot use gas. This is simply not reflecting the reality. And then finally, just related to that, I think this sense of the microscope, and this led to a thing called the JET-P structure that we thought up for COP26, which is, instead of having these general conversations, let's put our arms around a country, let's find out what they need, and then let's command public and private capital to deliver that. Incredibly effective, but how do we govern that? How do we make sure that the lessons are transferable to the next country? And I know you're working on this. And related to that is, I'm not convinced that politicians in many parts of the world are great custodians for these long-term transitions. I mean, my government in the UK has effectively shut down the COP unit, is now looking at rowing back from its own net zero commitments. And so having some of these longer-term structures in place, supported by organizations like GFANZ, I think is a way of making sure there is longevity in the transition structures we need.
Just to build on that, and if we take a step back and think about what are some of the key challenges for managed phase-out in emerging economies, there are broadly three key challenges. The first one is about cost. How do you finance, or who's going to pay the cost for managing phase-out? Because essentially we are cutting cash flows prematurely in assets around the world, right, leading to someone bearing the cost. Now, in places like Europe, in Germany, for example, the state pays that cost, right? In Germany, for example, I think they budgeted somewhere between 70 to 90 billion euros to finance the phase-out of coal. But we cannot realistically expect governments, emerging market governments in Asia to be financing that cost. And so the first challenge comes down to who pays for the phase-out of coal. The second challenge comes, and Jean alluded to it earlier, the cautiousness of capital. If we think about it, the key issue here is that, yes, even if we agree that there is a role for concessionary capital, a role for private capital to play, they may not want to play that role. They're concerned about touching anything heavy emitting, particularly around coal, because it puts them at reputational risk, it exposes them to compliance risks. So that's the second challenge. And the third challenge comes from the operating environment itself. If we look across Asia, the Asian coal fleet is very young. It's between 10 to 20 years old on average, compared to about 30 to 40 years old in Europe and North America. What that means is that coal assets are difficult to retire naturally, and a lot of the economic value remains within the asset. And layer upon that everything that Lord Stern spoke about this morning, about political risk, about currency risk, about offtake risk and credit risk in emerging markets, and you have a very challenging operating environment for managed phase-outs to occur. And so there's some three key challenges from my perspective. One, around cost, who's going to pay for it? Secondly, around the issue of the cautiousness of capital, how do we mobilize them to act? And thirdly, the challenging operating environment in emerging markets.
Thank you. Let me just begin by, I just want to take a moment to say thank you to the organizers. I think this is a very important forum, and it's a privilege to be here. I think the comments from my colleagues on this panel have illustrated that this is not only the last panel of the day, but it may represent the hardest of some very, very hard challenges that we've talked about. And so rather than doubling down on the complexity, all of which I concur with, maybe I can talk about a problem that I think is both large and potentially addressable. And that is that I think one of the challenges, generally speaking, in constructing the platforms and instruments and tools that will help us navigate energy transition, and certainly that we have experienced at ADB in some of our work in this area, is that because collaboration and institutional evolution are actually essential to designing tools to address complex problems like high-emitting asset transition, the first posture is often to say, well, if the government does X, or if philanthropy does Y, then my organization can do A, B, and C. And I think all of our organizations, whether they're institutional investors, whether they're developers and asset managers, whether they're MDBs in the public sector, whether they're truly catalytic capital like philanthropy, I think that our organizations need to be stressed to their limit. Because if we think, for example, about the chart that was up in the morning where we had a line between bankable and unbankable, I would argue that actually there's a meaningfully large swath in the middle, which is the should be bankable but isn't. And that's really a problem of business model, of financial intermediation. It does take catalytic capital, and the emergence of philanthropy as a major player, I think, is critical to that. But I think that actually represents an achievable outcome. And I would certainly say that the world is moving in this direction, whether it's organizations like GFANZ, which is a serious, serious statement by the financial services sector that it's going to evolve, whether it's other forums, including this one. I think we're moving in that direction, but I do think that there's more that can be done.
It's very interesting. If I tie back to what you say, which is who pays, and what I hear from you, there's a big part of this whole bankable, unbankable space, which should be bankable. You just need to get the catalytic capital in there. Who will do that? Is it the impact funds? Is it the philanthropies? I mean, how do we get the ball rolling on this one?
Yeah, it's a really interesting question, because I think often people conflate impact funds and philanthropy and talk about them as one bucket. And at least for me, they're extremely distinct. I think the evolution of corporate governance, stakeholder capitalism, the sense of corporate responsibility that's emerging, is tending to drive impact and general corporate governance towards, maybe it's a long time to get there, but at least a sense of universal ownership amongst these various actors. To me, the real catalytic capital in the system is actually the emerging philanthropists. And I think Senior Minister Tharman earlier cited this 2% number. John Doerr put a target out, 20% of philanthropic capital should be dedicated to climate. Organizations like mine, the ADB, are often, in this nexus I was talking about, where people say you should do something. Often people will say, well, you take the risk. The reality is we're scaling agents in hard places. We're not risk transfer agents at that scale. Somebody's got to fill that gap, and it's quite interesting that we have a group of actors, under the rubric of sort of philanthropic capital, i.e. I will invest to make a difference, that are emerging, and I think they may end up being some of the most consequential players in this ecosystem.
Well, that's very interesting, and maybe if I draw you and John on this one, what has been your experience as a role of the private capital And how are they kind of bringing in this catalytic capital to bring this whole ecosystem together? And maybe the learnings from the Chile that you were talking about, and what can the world do to scale this thing up?
Yes, so Amit and I have had this discussion many times, but I think maybe it's overly simplistic, but my personal view is that it's not an issue about the availability of capital. There is more capital today available and ready to be deployed around the world, particularly around topics of sustainability. Now, 3/4 of all inflows are around ESG mandated funds. I think Mark Carney, in his comments today, talked about the $130 trillion amongst the financial institutions ready to be deployed for sustainability. What the challenge is figuring out how to deploy that capital in well-structured projects in stable regulatory regimes where the unit economics make sense. And that can't happen solely by the private sector. It has to happen in deep cooperation and coordination with government policies and with public sector financial institutions. And so one of the most recent examples to speak of is the example of Chile. David had talked about the example of Germany. That's another country that has been very successful, including the UK, in terms of decommissioning of coal-fired power plants. But Chile, within the emerging context, is one of the few really strong examples. Just a few years ago, coal made up 40% of total generation in Chile. Chile has a very long history of coal mining and coal-fired assets. Its electricity grid had major challenges to bring on new renewable energy. Actually, the north of the country, where all of the renewable resources sit, actually wasn't connected to the south part of the country, where all the population sits. And so in a very short time period, there was this great coordination of government, of private sector, and public sector entities. The government implemented a carbon tax of $5 per ton. They basically made it impossible for new coal-fired power plants to bid by putting on a $40 per ton social cost for coal. And they started to invest heavily in stabilizing the transmission grid and renewable power. This had a tremendous cost. At the same time, financial cost, as Dave was mentioning, at the same time that there was significant social unrest in the country. And so what the government did was they enacted a tariff stabilization law to try to back end the cost of this transition when all of this cheaper renewable energy would become available in the next 5 to 10 years. And so Goldman Sachs was basically able to support the government, because effectively what they were saying to the generation companies is, we're not going to pay you what you're owed today. We're actually going to push out what we owe you to the future when the general cost of electricity will come down into the country. So Goldman Sachs created a SPV and basically purchased all of those receivables and securitized that cost over time. And we worked together with the Inter-American Development Bank, who acted as one of the first major anchors for purchasing the bonds, the zero coupon bonds that were used to fund those receivables. So that's one example of how all three of these work together to support the decarbonization in Chile.
That's interesting. I have a question for you, Claire. I think you're already ready to answer that. But maybe I'll just build on that and then you go. So you said, look, I mean, as you rightly said, there's a lot of money lining up to get deployed. And there's no shortage of potential projects where they could be potentially deployed, right? You talked about like 1.6 to 2 terawatt hours of coal-fired capacity. And of course, as you can see from some of the questions as well, coal is not the only high-emitting assets that could be potentially stranded. There's a lot more. We see a demand side, we see a supply side. Clearly, the pipes are missing to make this work. You created a kind of a sandbox of that in Chile. Claire, the question for you was, you have worn many hats as a minister, as a former minister, as part of the Powering Past Coal Alliance, as GFANZ, as and many other things. What, in your experience, are some of those biggest levers or those pipes that can enable this at scale?
Well, I thought John's example was brilliant. So the biggest lever is sort of conviction. So because these assets are essentially in the money at a domestic level, you have to have that government commitment that this somehow has to go. And the issue with coal, and I'm sorry to go on and on about it, but it also has tons of disbenefits as well as being high emitter. It's terrible for air quality, it's terrible for health, and so you can generally build a consensus, and we see this even in countries like India and China, where there are massive air quality problems in the cities, that you can generally build a good consensus that coal should be the first thing that goes. So the government has to have that conviction and be prepared to engage with the social consequences of this, whether it's the transition for the people, the workers, or the potential interruption in energy supply. You have to have an engaged government. And again, I don't want to traduce my former profession, but this is tough. Politicians generally have a fairly short-term view, not in this superb state, and thank you very much for inviting us. It's a very wonderful conference, but generally we tend to work for the short term in the political system. So you have to have that conviction, and then you have to have really smart people involved. And what I love about your description, John, is you touch on a lot of the themes, the securitization model, the activation of capital, which can be very different capital pools. Back to Ahmed's point, the same players may not be playing the same, playing in the same structural part of a deal in every single model. But one of the challenges is and Deanne talked about this on her panel, we don't create templates of this. So then we go back to square one and we start again, and we'll be working with a different development bank, we'll be working with different government aims. And one of the great things I'd love to see, and whether it sits with GFANZ or it's another action for Singapore and the region, is why don't we just create a brilliant SWAT team of people who've done this and ship them around the world and say, look, you get for free the brightest minds who can come and help you on this. And wouldn't that be a cool thing to work for a couple of years? I think it would be great. So we recreate a solution every single time, and we don't learn and basically have a rapid process of cycling through what could be. And there are plenty of governments, and we know Indonesia is one, we know Vietnam is another, potentially Thailand, who are close to that tipping point of really wanting to commit to a coal phase-out plan. But they need a lot of help because of the underlying economics and the fact that we don't price the externalities, the negative externalities coal creates. And we really need to find a way, because the more we can show countries that this is possible, the easier it then becomes to engage. Can I make one other final point though, which is, I talked about having a telescope and a microscope. The challenge with the microscope, and this is happening now for all very valid reasons, is as soon as you start talking about an energy transition, governments say, well, hang on, I'd actually like you to help me think about my transition to electric vehicles, or I'd like you to help me with electric heat pumps, or something else. And then you have a Christmas tree which is covered in ornaments, and you actually can't. It's not a great analogy, but you can see what I mean. Then you can't make progress. So there's something about being very specific about the target, which is, in this case, we need to move to the PPCA aim, unabated coal generation by 2030. And I say unabated for a reason, because the other thing that is shifting is the world is waking up to the need for massive carbon capture at scale, whether it's through NCS, as we talked about, or through engineered means. And the USA has, massive shift with the passage of the IRA. But again, we've spent far too long debating the ideology of the need for carbon capture rather than getting on with in-the-money solutions. And frankly, if coal power wants to install CCS, which is a highly expensive opportunity, bring it on. If you can have zero emission coal generation, and you're doing that for the right reasons. I mean, I don't know if people out here check the Keeling curve on a daily basis like I do, but Minister Tharman said it well this morning, and it really relates to a question that's come up about, can't we just accept this, that we're going to have to pay? It's not going to work like that. This is not a linear transition. He described it as we're in a race for our lives, and not to scare you, but the Keeling curve is at a level that we have not seen for the last 800,000 years. This is a measure of CO2 in the atmosphere. We don't know how to deal with this. We're outside our climate tolerance levels. And if we had got rid of coal and gone to gas, in the 1980s, we'd be in a very different place. So for me, coal does remain a real focus.
It's very interesting. You talked about economics, you talked about talent and capability building. I'll come to you, David, in just 1 minute, but just building on the cost, CCS, etc. There's always this question of who pays, right? Amit, ADB has been driving this energy transition mechanism program in some of the countries here in Southeast Asia and broader Asia. What's been your experience? What is the real cost? Who's willing to pay for this? Because unless we address that question, it's really hard to move ahead with this.
Yeah, no, thank you. And maybe for those who aren't familiar with it, we, a year ago, publicly launched at COP26 an effort to design a voluntary, scalable, blended finance scheme for accelerating coal transition in 3 target geographies in Southeast Asia: Indonesia, Philippines, and Vietnam. And I think that there's been quite a bit of learning by doing since then. But just to hone in on your last question of who pays, the first question is really, through what structure and mechanism and set of arrangements. And by the way, I love the telescope microscope. I think because you start with the telescope, this is a really big problem. But then you very quickly end up in the microscope and you say, well, what are the legal arrangements? What is the valuation on the books of the state-owned entity? What are the laws around depreciation? And it gets extremely technical at a country level at a minimum and maybe lower than that. And so problem 1 around who pays is designing the instruments and interventions through which that payment will be transferred. But ultimately, who pays will be, I think, a mixture of, as ultimate owners, either asset owners or taxpayers through various instruments, public sector MDBs, or asset owners, i.e. institutional investors, through investment that earns an appropriate return. I mean, at your highest disaggregated level, I think that's who pays. But finding the right mix in the right context can be quite difficult. If I take, for example, some of the deals that we haven't yet announced, but we're in the midst of structuring, what we have found is that the principle that seems to work best is the principle of shared pain. And the principle of shared pain works when you have another important principle at play, which is a shared objective. And we at least have found that in the work we've done today, that if you don't have actors who align, lenders, off-takers, sponsors, the public sector, all of whom share the common objective, and who elevate it above, for example, pure financial return, you're not going to find a structure that, in an equitable way, apportions the cost. If you have that alignment, then you have the de minimis criteria needed to investigate a structuring solution that may work. And then the last point I'll make is that there are many tools we're designing today that have significant shortfalls in terms of how the numbers run out. The missing link here, and the critical missing link, is going to be carbon offsets. And creating a certification regime for carbon offsets associated with coal-fired power plant shutdown. And what will be absolutely critical is to make sure that is a very small subset of existing coal-fired power plants. Because a large majority of them will be subject to market forces, but a significant enough minority will not. And this is what John was talking about earlier, whether it's because there's long-term PPAs, whether it's because they sit on the balance sheet of a state-owned entity and are protected in various ways. There is a subset that's just going to keep pumping. If you can get offsets for that subset without over-inclusion, all of a sudden the numbers work much, much better.
So very interesting, and actually there is one of the questions which I will not wait for till the end, but exactly on the carbon credits, right? It's a big question on the cost. We talked about the nature-based solutions and the credits. What will it take to scale up the whole carbon credits or creating an offset on the back of the early retirement of coal-fired power plants, which can bring some of these into the should-be bankable thing, right? So have you seen that, or maybe John, from your experience of securitization of some of these, what will it enable to be scaled up very quickly?
So I think Ahmed is absolutely right. I think there will be a subset of this managed phase out where the economics just don't work. And we talked about the significant high cost. And by creating a carbon credit where there are thousands now of corporates around the world who have made net zero targets, they won't be able to meet them without some kind of offset. And so creating an offset that would then support managed phase out is, in my view, incredibly important. The question is, how do you do that? It's how we've done it for a number of other carbon credit types. We've talked a lot about today about creating a standard, creating a template. You've got to do that first. And it's likely not going to come from the private sector because we all have tremendous fear on the reputational risks around this. And so there needs to be a governing body, whether it's an NGO, government, and multilaterals, DFIs, that help to create this standard of what qualifies as a quality managed phase out for carbon and then carbon credits. The next thing that you need is obviously a platform and exchange. And so obviously visibility on price, on volume, those are types of things that the private sector can help to manage and create, like we're trying to do now for nature-based solutions.
Have you seen David, I'll come to you. David, have you seen roles that public sector is willing to play in creating this kind of a standard? Or if GFANZ is working or talking to the others to create this ecosystem?
Sure, no, thanks, Vishal. I think when it comes to carbon credits, particularly for the early phase out or for early decommissioning of coal, one of the things is to work with some of the schemes that are out there. Gold Standard, Vera, some of these schemes out there, they need to buy in to say that yes, this is important and this needs to be something to be developed. The standards need to be developed. I think it's something that some of them are looking at, but it is still nascent, and a lot of the schemes, as you know, some of them are NGOs and are non-profits. They are strained in capacity as well. Now that said, beyond looking at just standards, there's also key to look at demand. Will there be demand or high enough demand for these carbon credits? Because technically speaking, these are not removal credits, and as we know, removal credits tend to trade at a premium to avoided emissions. And in some sense, this is a form of avoided emissions from the early shutdown of coal-fired power plants. And the key question here is there demand for it? From our initial engagement with some of the brokers who do trade in carbon credits, there seems to be the suggestion that yes, there is, if you incorporate two key things. One thing around the just transition, right? From what we have heard, that avoided emissions, avoided credits with just transition for phase out of coal could potentially have prices of up to $10 to $15 per ton of CO2, at least that's what we heard from the market, which is really high and actually very close to a lot of the nature-based solutions pricing that's already out there, which circles back to the importance of just transitions when it comes down to the generation of carbon credits. The second issue, of course, has to do with transition credibility, because banks and buyers of carbon credits are not going to touch anything related to coal if it's not credible. And that's the key issue now on why so many banks and so many financial institutions are so cautious when it comes to transition finance, particularly the managed phase out of coal. There's things around the transaction level where the key question here is on meaningfulness. Can this even be considered a managed phase out? We don't have a rule book out there right now which says if it checks 10 boxes, it's a managed phase out. Otherwise, it's a greenwashing and you're financing fossil fuels. So that's something that is key to be developed. At the transaction level, what does a meaningful transaction look like? Does it, for example, follow the IEA pathway for phase out of coal by 2040? That will make it more credible versus just shortening a coal-fired power plant life by 5 or 10 years. But beyond the transaction level, at the institutional level as well, the key issue here is that a lot of financial institutions may not even be able to transact. Deal teams can bring it up to their board and their investment committees, and they are not able to transact because financial institutions, a lot of them have very raw and blunt policies around simply no coal, do not touch coal transactions. Or some others with sustainability teams would then say, hey, this is going to lead to a spike in my finance emissions in the short term. Do I really want to finance this and put myself out there with that kind of risk? So we need to engage those things. When we talk about financing structures, talk about carbon credits, we have to solve first the issue of of the just transition? How do we incorporate that into managed phase out of coal? And secondly, how do we ensure that transactions are credible from the perspective of both the transaction itself, but also from the perspective of the internal processes of banks? How can we move beyond portfolio finance emissions to look at forward-looking metrics that can account for the managed phase out of coal-fired power plants or high-emitting assets, more generally speaking?
Yeah, I want to just build on one of the points that you mentioned about this being treated as even as a managed phase out, given the taxonomies. Does it count as quote-unquote green or not, right? And there have been a lot of discussions on taxonomy and the fact that we need to fix it. What are you seeing from a GFANZ perspective, or any other reflections on what does it take to move on relatively simpler sounding things like fixing taxonomy?
So when David was talking, it was one of my first comments on what the big challenges are. Currently, based off current taxonomy and current carbon accounting, a financial institution investing in a managed phase-out project is still investing in coal. We completely understand that reducing absolute emissions is the end game, but what's the best framework to get there? And so long as those are the rules of the road, it's going to be very hard to scale up financial institutions and banks into this game. So what are the potential solutions here? You know, one could be to look at physical emission intensity and the reduction of physical emission intensity for banks. One could look at maybe a forward-looking metric would be another way to look at this, but based off of the current taxonomy, very challenging.
And there are big regional differences. So under the EU green taxonomy, you couldn't invest at all in repowering, if you like. The US doesn't yet have a taxonomy, and I know we're having sort of conversations about what it looks like, and it gets back to where we started this morning, which is, you know, we have a very insular view of what the transition should look like that's based on a very old power fleet that has largely been depreciated in the Northern Hemisphere, and you know, these one-size-fits-all solutions just don't work. And it's been interesting in GFANZ that, you know, some members have started to say, we don't want to run a legal risk of participating in things that we know we can't deliver. It doesn't mean we shouldn't set the targets. And I guess I'm just a massive fan of transparency and disclosure. And you did great work with the deals, the really interesting deals you were proposing into COP26. You know, if we set those targets and we can demonstrate year on year that we're working, you know, we're very bad at going back and showing progress. We're very good at starting new coalitions and coming up with ideas. But you know, you'll know there is no mechanism in the world that adds up all of the corporate commitments, GHG emission reduction commitments, and puts a ribbon on them and puts them up on the main stage and says, what have you done this year? And one of the things WBCSD proposed into COP26 was a corporate determined contribution, where alongside the NDCs, which, by the way, governments, again, don't always deliver on, only of the 163 commitments to produce an upgraded NDC by last week, made in Glasgow, only 19 countries had delivered by the deadline, whereas I have yet to see any company that has rowed back on its net zero commitments. In fact, we've seen the opposite. So finding a way to show the validity of these commitments and being extremely transparent about the proposals that are being made, and also, I guess, showing, as you did with the Chilean example, that this is possible. I think all too often we just assume that this is an insurmountable problem. It's really not, and the price of carbon's only going one way, so the economics of it start to become more real. But we're not good at showing that commitment and transparency, and I quite often say to banks, you know, be courageous. You know, as we've seen in some of the banks in the region, it may not fit a taxonomy, it may not be a perfect glide path, it may not be what a science-based pathway looks like, but just be courageous and stand up every year and show how you've delivered against it.
Yeah, so Claire, I'm going to come back to your microscope telescope.
How do you like that?
I like it. I like it because I think
debate.
this is a great example of that. We defined a rule using the telescope, no fossil fuels. Okay, but now we're in there with the microscope.
That's a lot.
And it doesn't quite fit. And so I'm optimistic because I think there is increasing recognition as it relates to fossil fuel reporting from financial institutions that the current rule isn't fit for purpose, that it prevents activity that needs to happen, And the key really is, you talked about courage. You know, when we launched our energy transition mechanism last year in Glasgow, you know, a major bank CEO said, I know I'm going to get in trouble for being here, but this is the right thing to do, and eventually people will come around. And so I think wherever we sit, you know, everybody's got to be focused on outcomes and resolving the common challenge we have. And every institution will, at various points in time, an individual will have to, you know, may have to take some risk in that process. And that is an absolutely critical part of getting us to where we need to go.
Absolutely, and it comes back to the point that you mentioned about both conviction, but also having the courage to do this and stick your neck out. Given that we'll run out of the time soon, two questions. So one is for you, John, which is, what's in it for the private investors to get involved in this managed phase out, given potential lack of returns? Like in the Chilean case example you talked about, you know, the zero bond or deferred returns. How should private capital think about this?
So once we've gotten the metrics and the carbon fixed, I think there's lots of innovation that's already happening, you know, around this point. And so I made the example of the zero coupon bond in Chile for securitization, but this is happening all over. In the U.S., there's rate-based bonds that basically states are effectively passing laws that ultimately, you talked about who pays for this, it's ultimately the consumer. And so ultimately including it in the rates and tariffs that are paid by consumer to pay for the managed phase out of coal, because ultimately studies show that there's actually significant benefit to consumers through improved health and environment, et cetera, you know, around this. There have been a number of other things that have been done with the multilaterals. We've talked about, for an example, the Inter-American Development Bank has developed basically a lending practice where, based off of how quickly you decelerate and phase out coal, the cost of the financing is attached to that and goes down. There are other ways in which blended finance can work, by which the multilaterals will either be an anchor investor to basically to provide liquidity, which is a very important point in terms of galvanizing private sector investment. And then finally, multilaterals providing first loss guarantees. That's been discussed today as well, but that's another area that can basically help improve the risk reward return.
Terrific, amazing. One last question before we wrap up is, it's actually related to one of the things that we see on the screen is, talked about this as a managed transition. It's going to take time. We also understand we don't have time, right? If there was one thing that we can do and we need to do to accelerate this managed phase out, what would that one thing be? Start from you, John, and come this way.
I like the carbon credit idea. That will make the economics, that will support economics in a very important way.
I think from the GFANZ perspective, it's really getting in there and moving beyond the metrics and targets that we currently have, moving beyond finance emissions and taking on more forward-looking guidance and forward-looking metrics. And actually on that point, if I may just add something else, that on this point around managed phase-out, this is why I think GFANZ, together with the Asian Development Bank, as well as the Monetary Authority of Singapore, we are looking to develop specific guidance around how financial institutions can approach the phase-out of coal-fired power stations in Asia. The intent of this is to provide clarity as well as confidence for financial institutions like Goldman Sachs and so on to participate in these projects. And we welcome financial institutions who are keen to contribute to this process, to express interest to us, to participate in this development of guidance as well.
Just choose one. So I think it's related to this conversation, almost closing our ears a little bit to the very interesting academic conversation that's run for 30 years since the Rio Earth Summit about, how we do this and what the pathways are. This is all really important, but we're out of time and we have to act, and sometimes having the courage to do it's really important. I think we did a massive investment in carbon removal, which we've talked about, and if I can just encourage everyone, have a look at the Keeling curve every day and go to bed feeling quite scared. Yeah, and truthfully, the measures are there, we have the data, we are so out of time, and yet we continue to persist as if this is somehow something that isn't happened. If anyone's seen Don't Look Up, we're kind of in that
Yeah.
stage right now.
Yeah, I can completely relate to that. Emmett?
I think the most difficult problems in the world today are also deeply interdisciplinary, and you can't think about them in vertical silos. So my answer for the one thing that would make the greatest difference is that we continue to drive down the cost of renewables-based baseload power, whether that's through long-duration storage, through SMRs. If we just keep those curves moving, as they have been, and perhaps with the U.S. climate bill accelerate them, this problem is going to get a lot smaller.
No, I love that. I know we are out of time, so if I just at least summarize some of the takeaways is I love this thought around having the conviction and having the courage. In fact, similar conversation that we were having with the MD earlier is what we need is a relatively smaller group of people who are willing to take bold steps, work with them. The second thing is, I love this, the whole telescope, microscope stuff as well. It is really getting into the details, right?
I thought that up over coffee, so you're very welcome.
Good coffee, clearly.
Great coffee, Arabica.
I think it's really possible to really zoom in on 2-3 of the biggest movers: the credit, the carbon credit idea, the innovative structures, the reducing the cost of renewables. So really zooming in on what are the 2-3 big things that will move the needle is really important, which needs to be worked on by this group of the coalition of willing. And the third thing is really learning by doing. I love that idea as well. It works in Chile, clearly. You could bring the catalytic capital and the commercial capital together. The question is, how do we really take that, scale that up from 900 to 9 billion to 90 billion and whatever is needed to do that, right? So, well, hopefully, there are enough stakeholders who will really, can get behind this and move, because you're right, we don't have enough time. With that, well, thank you. Thank you for your time and lovely conversation.